Recording in
Next
progress.
is stocks are all around us. Now, what I mean by this is probably the most exciting thing and, can be most distracting thing about the stock market, but definitely the most exciting thing is stocks are everywhere. And what I mean is whenever you walk into a store, whether it's a convenience store, a gas station, you see a brand like Coca-Cola. Coca-Cola is a publicly traded company and it's everywhere you go. So it's definitely, that's what I mean by stocks are all around us. Apple is, I'm on an Apple computer right now. So I have this general knowledge of Apple products. I sort of understand it. It could be something that I pay attention to. Easy for me to digest the news. Shopify, something we use often. Google, this is probably the most common used thing in the world. Amazon, think about it. How many times a day does the Amazon truck go to your house? I know that Amazon truck stops by here several times. So it's especially this time of year. And these are all companies that, are publicly traded and we can contribute to. There's Verizon, Snapchat, Netflix. Now, to give a quick example of, some price action and news and whatnot, before Netflix last earnings call, stock was down, and they gave a positive look at what the future was going to be because they had ad services that were going to come out. So then the market saw that and they really reacted to it. Stock ended up popping and now Netflix goes up. So it's all these little things, Tesla, Ford, all these companies that we know. When I say stocks are all around us, they really are. Everywhere you go, every store you go into, it's something that is very easy to understand. The idea of, hey, you know what? I'm looking at this. I'm on this computer right now. You can easily find something that you can pay attention to, and that you can easily understand the idea of how news or any economic event may impact the stock price. So when it comes to trading stocks, as I said, there are a lot of different ways to do it. There are a lot of different strategies and a lot of different ways to buy and sell. Now, we cover a lot of technical analysis, a lot of charting, and we'll get into a little bit of charting a little later. But I'm going to, before we do that, I want to throw a different way of trading, a different strategy that I don't think many people know when you first get into the stock market, or the idea of trading for that matter. And these are called stock options. Now, there's going to be a couple reasons that I like options. And this is going to be like, from here on, it's going to look like what one of my go lives looks like. I definitely focus a lot on options trading because that's the kind of trading that I like to focus on and teach people how to safely do. So options are different than just outright buying stock. It's similar, but a little bit different. And we'll get into that right now. I'm going to pull up a slide here. So an option gives you, or gives the investor or you, the right, but not the obligation to buy or sell a stock at a predetermined price on a predetermined date. So what that means is it's essentially a contract. It's a contract to control 100 shares of stock. And before you make the trade, this is what I think is probably the best part about options. Before you make the trade, all of your risk is identified. So let's say you are buying a contract. If it's a strict premium contract, when you purchase that premium, that's the max amount that you could lose. So that is one way to go about thinking about options. It's not about the leverage or the ability to 10x your money. It's about just knowing that, okay, this is the max amount that I could lose if I'm buying premium. And that, to me, having that peace of mind is great when you go into building out your strategy. So basic ways to navigate, there are two types of options. There are puts, which is a bearish take, and that stock will go down. There are calls, which is a bullish take and a bet that stocks will rise. So calls and puts are the fundamental building blocks for all option strategies. They can get really complex in how you arrange and organize them, but it is the fundamental building blocks for all of it. So right now I'm going to throw a bunch of information just about what this all means, and then show you a real life application of how it would potentially look on a chart, and then in an actual trade, how it may look. I'm gonna have a sip of water real quick. I just get, so excited about options, dries my mouth out. So again, I'm just going to cover really quick. Here we go. Just as a quick recap, calls and puts, they're the building blocks for everything. And they control 100 shares. That is a great 100 right there. 100 shares. So one put is equal to 100 shares. One call is equal to 100 shares. Next slide. Here we go. Okay, so this is what an options ladder looks like. It is built of strikes, calls, and puts. Now on this side here, this is going to be the call side. That didn't work out, right? But we'll get rid of that anyway. So on the left side is going to be the call side. So we have strikes, calls over here, and puts over here. Now, like a regular bid and ask on if you're buying stock or buying, whatever market you're contributing in, there is the bid and the ask. Now, how this works though is a little bit different, because with stock options, you have stock price here, and then you have the bid and the ask here. Now you'll notice that stock is $134 right here, but the ask price is $1.56. Now, what does this mean? This means that this is the ask for the premium, $1.56. So you take that $1.56, remember it's 100 shares, so it'd be 156 times 100 times 100 equals $156 is what it would cost to control the 100 shares. Now, it is time-based as well. So you also negotiate how many days are left in your contract. In this image right here, it shows that there are 2 days left. So the risk would be $156 for 2 days. So you'd need volatility to push, you need stock price to push up for this to be valuable. So now we're going to pull the next slide in. So we have the strike section right there. These are all the different prices that you can negotiate for. It doesn't have to be one specific price. It doesn't have to be where price is. You could buy a call for 129 and stock price is 134 and you'd be already in the money, but it would be more expensive. You could then see the bid, the ask, the call side, and the put side. So this is the two things that we're always going to remember when we look at options. There's a call side and there is a put side. Now, to explain a little bit about how they're valued, because here we have the stock price, and why is it so different from the bid and the ask? Well, it is premium that you're paying for, and what dictates the price of the premium is the implied volatility. The implied volatility is the forecast or the likely movement in the stock price in either direction. So it's used to price options contracts, and high volatility results in options with higher premiums, and low equals lower premiums. Makes perfect sense. So now we're going to look at this really quick on a chart. Let's pull up a line here. Move this so I could see. All right, so we feeling good. We're understanding so far. I feel like I feel like it's going great. I feel like we're going great here. Typically I have music on. I think that I get like I'm a music guy. I need to have a little vibe. So I'm going to pull up what the options ladder or chain looks like. Right now, this chain is Bath and Body Works. So you can go any company. We talked about Apple earlier. So let's just pull up Apple. Oops. Here we go. Here's Apple, and we're going to pull up the options chain just to get a look at what it's like. So Apple currently at 147. This is the expiration that I was explaining earlier. So you have your expiration here. Expiration December 22. That's December 2nd. That is tomorrow. So we don't want that one. We want to go out a little bit farther. Let's go December 30th. So December 30th to buy a call. So we have $147 stock price to buy a call at that area. The ask right now is 545. So you'd take 545 times 100, and that would give you what that is. Now, the question in your mind is probably, how do you make money off of that? Or how do you turn that into a profitable trade? And what can you even do with that? Essentially, what you're doing is you're saying that price is going to go up when you negotiate this contract here. Price is going to go up. And as I said earlier, this gives you the right, but not the obligation to buy. So if price goes up to 170 by the time that this expires, you still have the right to buy it for 147. So you can do that. So you can buy this stock that costs 170 at 147. So you have the right to do that, but not the obligation. You do not have to buy it. You could also sell it before. So if it does jump up and there is value here, you can then sell your options without having to buy the stock and collect the premium on top of that. And I'll show you what that looks like too really quick as a quick example. So let's pull up Apple here on this options calculator. So what we said before was 147. Now we're going to put this for December 30th and not at expiration. We're going to go right around here. Then we're going to pull this out. Now, obviously, this is, it's not likely that it's going to go to 170. That's not going to happen. But you see, if price is here, as soon as price reaches the 150 mark, it's 147 now, you start to become in profit on an option. So your max loss, 543, that's the max you could lose. And then as time goes and as price goes higher and higher, your profit then goes higher and higher. So essentially, to get to this point of break even, price has to be at 150.52. And then you gain in profit after that goes. Now, I'm not saying it works out that way every single time, because it certainly doesn't. If it went to 170, it would be, valued at 3 times what you paid for it, but it doesn't necessarily always work out like that. So that's why you have to protect yourself. And we're going to get into that in a minute. But now we're going to get back. I just wanted to give a quick visual of what it all looks like here. So back to this calendar. Here we are looking at Apple and you see the bid, the ask, the strike price, the put side, the bid, the ask, and the strike price. And then some options change will also give you volume on it, like how many people are buying these contracts at this time. Like this 157 has 1,200 contracts. It's, this information is out there. There are a lot of different calendars and calculators, or whatever works for you is really what you have to do. But now we're going to take it another step further. We're going to look at this on a chart and see what it looks like and go through this trade as if we were we were looking at it in real life. So we're going to take a quick pause from the options, and we're going to use one of my favorite tools that there is a screener. So I'm going to reset all the settings on the screener. Now, if you're brand new to stocks as well, you're going to say, hey, okay, it's overwhelming. There's thousands, literally thousands of stocks out there. What do I even look for? So here we are. You see this ticker symbol right here at 13,257 stocks to choose from. You're not going to scroll through everything. Some of them are obviously going to be garbage. Some of them are going to be way too expensive. It's going to be a whole lot of information, a whole lot of things that you have to try and pay attention to. So that's why we use a screener to help us find how we can narrow this down. And I know that this is a lot of information. I know I said that I was going to hit a lot of information, but that's why I said just come to the Go Live. We'll fine tune everything. This is a lot of value at a rapid rate, but I feel like it's all very, very valuable to have a broad knowledge of. So first, we're going to go to descriptive. If you've never used a screener before, it's a great tool, and you can really narrow down how you find your stock. So I'm going to go to exchange first. Now, I prefer everything minus the OTC market. And then I'm going to go to average 30-day volume. This is going to be an easy one that we do. That's going to be a very basic screen, but just to give you an idea, the tools that are out there are great. And then we're going to combine it with the technical, and then combine it with the options, and we're going to be loving it. So 500,000 to 20 million. It's a broad area, but you could see that we're already down to 2,683 stocks. Now we're going to take a look at, let me see really quick. Yes, so we're going to take a look at, let me see, there was a couple questions here. I'm sorry, I'm going so fast. I apologize. Let me look at a couple of these questions. Yes, so the ask, here we go. The ask is on the options. We'll get back to that the next time I pull up an options chain, and I'll show you so you could visualize and see it. But the ask is, 100 times the ask is what you are paying for the actual contract, because an option is controlling 100 shares of a stock. So say, for instance, if the ask was 58 cents, the reality of that on paper would be 58 cents times 100 would be what the options contract cost. But I'll show you that on paper when we get there. So here we go. We're going to continue to do this, to the screener here real quick. We're going to not look at the symbol type. I don't think we need that. The submarket, the country we'll leave to any. Let's go over some financials right now. Now, a big one for me is PE, is price to earnings ratio. This is one that I love. And I'm going to select the between function, and I'm going to go between 5 and 20. Now, what this means, because a lot of people don't, if you're brand new, you would not know what this means, but your price to earnings, your PE, is a type of valuation. Essentially, what it takes your earnings and whatever it's multiplied by to get the stock price is the PE ratio. So for instance, if you have a company that trades at a super high ratio, like let's say Tesla, which trades at around a 60 EPS, it could be looked at. Some analysts may say that's overvalued, it's way too expensive. Whereas a Bank of America trades at 10, I think, or around 10 PE ratio, which is 10 times its earnings. So that is a lot more affordable, whereas the market average is somewhere between the world of I believe it's like 16 or 18, something around there. So that's the average. And over that can be looked at as potentially overvalued based on a bunch of different parameters and fundamentals. But that's just one quick way to narrow down things that may have been overinflated. So we're like protecting ourselves against that type of bubble potentially. So we're going to look between 5 and 20. Now we're going to look for earnings coming up because major catalysts are big promoters of volatility. Not like we like to use that totally, but for this instance and for this example, it will definitely help us just find things that may be a little bit more interesting just for this lesson. So we're going to go this month of December earnings. So this is going to take us down now to 17 matches. Now, let's just do one more. We're going to do technical rating. This is going to be super easy. We're going to go very, very broad stroke, strong, buy, neutral, and that takes us to 15. Good enough. So we've narrowed down now 2,000 stocks, or I mean, 2,000, what am I saying? Nearly 14,000 stocks to 15. So now we have a little bit better of an idea of what we're looking at. We could say, oh, awesome. I can handle 15. Can't really handle 14,000. So one company that keeps popping up is ASO. So we're going to look at ASO really quick, which is Academy Sports and Outdoors, Inc. So we've seen that. It's the first one on the list here, and we might as well do it. I already have a tab open because we were doing it in a go live this morning. So here's ASO. Here's what it looks like on a chart. Now, this chart might look a little bit different than the chart that you use. You can customize it to whatever works for you. I am a big fan of using momentum and the direction that price is headed in to base some trades off of. So one of those big momentum indicators are going to be moving averages for me. So I have all these moving averages. I have the 200-day in red, the 50, the 3, the 5, the 8, the 13, and the 21 as my swing band averages. Now I'm looking at swing band averages because I like to look at option swings. That is one thing that I like to look at. So I have my chart set up for that. So the 5 and the 13, these moving averages this is like a short-term momentum. So when I'm looking at these, I'm using more than the 5 and 13. These are all the 3, the 5, the 8, the 13, and the 21. And the reason that I'm using all of these is because it's a gauge of momentum for me. The wider that the 3 is from the 21, the more spaced out everything is, the more pressure that's pushing upwards. Now I'm using a day chart, so this is going to look different on all time frames, but for the day time frame, as you can see, it's pushing momentum upward. So right now, in the past couple days, and this is just because I have a broad knowledge of this, is starting to push down, and the 3 cut through the 5 and the 8. And for me, that's a signal to say, okay, maybe if I got in here or in this area when momentum started to push upwards, this would be a time for me to consider positioning out or thinking of how I can hedge at this point, because with options, it's not just buy and sell. You can roll your options into a new contract. And we're going to try and cover that. I know that I've been going for a little while now. I'm going to try and sum it up here. But as price pushes forward, we see this. Now, this downtrend, now you could say, why is price moving down now if there was so much momentum? Well, this is a sporting goods company, and recently there's been a lot of retail earnings, and this is probably off of the wins of a couple other sporting goods stores reporting poor earnings and price moving down, and sentiment overall is now affecting this stock price. Now we see this in in what I said earlier of how I can get a bad review, or somebody can say that this song isn't good, and then all of a sudden nobody likes that song. Well, it's the same as this. There was a very close related company reported poor earnings, and this stock went down because of it. So it's very similar in those ideas of sentiment. So now back to this. If we're looking at ASO, and I'm just going to show a really quick example here because I know that I'm probably running out of time. We're going to pull open this calculator one more time, and we're going to go to ASO. There we are. Bam. It looks great. Now, right here, you see this chart, and it's like, yeah, well, so some lines. I don't really know what's going on. Well, I'm going to explain it really quick. So today is the first, let's say January 6th is where we want to have our options expire. Now, price is $49. So we're like a $50 call. That sounds great. $50 call. That puts us right under where almost valuable. Now it's almost valuable. And we know that we have a major catalyst coming up. Next Wednesday, a major catalyst comes up that's going to affect stock price. It's either going to go up or down. Maybe sideways, but probably up or down. And if we look at the last earnings call, which was back here, this is TradingView, by the way. It gives us a lot of historical data and knowledge. So this was a 23% move off of the last earnings call, roughly 10. So not saying that that's going to happen. It's probably not going to happen the same way at all, but we know that it can get really volatile during this time of, during this event that's going to happen in stock price. So it could go up 10, it could go down 10, it could go sideways forever. Just throwing it all out there. There is no guarantee. So, okay, here we go. If stock is $50 and it costs us $355 for the premium, that's our max loss. That's been defined. And once stock gets to, let's say it jumps $10, this would be valued at, I'm not saying that this is going to happen again. This is just examples. If the same thing happened as the last earnings call and stock jumped $10, that would be roughly 700, so over, you'd have almost 160% profit on that. But what if it goes the other way? Then you lose all of your premium. If it goes $10 down. So if it goes down there, then that's it. But here's the thing about option strategies. And then I'm going to try and keep this quick to pass it back over. So an option strategies, and this is why I think that it's extremely valuable to know and great knowledge to have. If we go here, we can buy a put. And this is called a strangle. This strategy essentially plays both ways. So if we play a strangle here, we have our max loss of 527. Now, price could either go up or down. But if it is as volatile as it was and price goes up to 60, then we have 100. We have one put and we have one call. So even if price goes now down, at that same point, you can still hedge against that volatility and make a profit. It's a little bit more expensive. Obviously, it's 527 is the max loss you can have, but it is a way to protect against volatility on both sides. So whether you're short and you're like, I don't know where it's going to go, I want to protect, then your call would be more profitable. If stock plummeted, then your put would be profitable. And you can see that you can use both ways to sort of understand how to hedge against potential volatility, which I opened this up with saying the market can be volatile. Yes, and volatility is something that, we don't like to base our trades off of. You shouldn't just go into something expecting volatility. But when there is volatility, you have to do things to protect against it. And that's where options really come into play, is protecting against volatility. If you're going into a trade with a max loss here, but because you're doing a call and a put in a strangle, you have your full risk right there. And if stock plummets one way, you're going to be okay. If stock jumps up another way, that you're going to be okay. So that is one of the benefits of options, and what I really like to, put out there is safely being able to navigate these things with, with the best knowledge that you can, best knowledge that you have. Another really, really very quick way is if you had 100 shares of this, say for instance, and stock price plummeted, or you were afraid that that was going to happen, you can you can open a put contract. And as stock price plummeted, and yeah, you're holding 100 shares, which is the equivalent of, almost $5,000. As stock price falls, your put becomes more valuable, hedging against the downside risk. So you're essentially protecting your portfolio with a move like that. Now, as I said, I know I covered a lot of ground, but I did want to get a lot of valuable information out there for everyone. So yeah, I feel like with that, if there's anything else, come to the Go Lives, come hang out. It is we go over a lot of information like that, a lot of valuable things. And yeah, I just want to say thank you very much for being on this call. Thank you very much for inviting me, Manny. I am so excited to be a part of it. So excited for the Academy, for SFX, for everything. We've got a great team all across the board, and it's been amazing so far. So with all that, thank you very much, and I will pass it back to you, Manny.
Ace, thank you so much, my brother. If you can, just feel free to stop sharing your screen for a moment and stay with me.
Oh,
I'm
yes,
going to ask you 2 quick questions. All right. Thank you. Thank you, man. That was absolutely phenomenal. And it was also very refreshing for me as well to be able to get your insight and your input on the market. I really love how you approach your education. And it's going to be very good, and we've been putting together some fast starts for the SFX family. So that way they know how to get involved, what platforms they need to use. So that way they can follow you guys properly on the SFX team, because you guys bring so much value here to the company. So first question I want to ask you, if any of our viewers want to be able to tune into you live, what days and what times can they find you on Go Live?
Right. I am on Go Live right now, 3 days a week, 7:30 a.m. Eastern time, Tuesday, Wednesday, and Thursday. But I'm going to start doing 5 days a week. So I'm going to start doing upping it a little bit more next month. So right now, though, 3 days a week, Tuesday, Wednesday, Thursday, 7:30 a.m.
Awesome. That's exciting. And then so now, second last question for the individuals that show up to your sessions. I know you just gave us a crash course on what you got going on, but if you could sum up, when our viewers are checking you out, what can they expect to learn as they are attending your sessions?
Right. I think consistency is something that I'm huge on, because it's not about having this big moment, this big splash right off the bat. It's about being able to not just trade today or build, whatever you're trying to build today. It's about doing it 10 years from now, 20 years from now. And that's something that, this industry has taught me, or the, entertainment, music, all of it has taught me, like consistency and doing it for the right reasons. And that's sort of like what my whole thing is about, whether that's trading options or however you like to invest. So that's what you could expect, though. You could expect trying to really push consistency over the long term.
Oh, man, we're so excited. Ace, we want to thank you so much for showing up to our 25 days of giving. I'm going to get ready to close out this call, but we want to thank you. We want to honor you. Everybody, let's go ahead and drop a 111 in that chat, whether you're here or you are on our live stream. Show some love to Mr. Ace Enders. I know a lot of people are very, very interested in the stock options market. And I think Ace is a phenomenal educator to get involved with. So as we get ready to bring this into a closing, over here, for those of you that currently are not a part of the IM Mastery Academy platform, if you guys do want to be able to get involved and get access to the SFX Academy, get access to Ace Enders as well as his team, you guys can feel free to just get in contact with the individual that has shared this Zoom link or this live stream with you. And if you are a member here at IM Mastery Academy and you want to add on and you want to be able to explore the SFX Academy as well, remember, you can simply upgrade your current package to the IM Power Pack for a few dollars more. And by doing so, you'll be able to mix and match your academy education. So you'll be able to have 2 academies for just a few dollars more each month on your monthly membership. And don't forget, you'll also get MMX for free for 90 days for those of you, current limited promotion, for those of you that get involved with the IM Power Pack. Now, if you guys want to be able to get involved in a community of traders, a community of entrepreneurs, if you want to come out, for those of you that love to travel, whether you are domestic or abroad, right? If you guys are in the States, you guys can come out to our IM Orlando Regional, or if you are in the European nation or on the other side of the globe, you can feel free to come meet us at the Netherlands. At IM Rotterdam, we have two major 3-day trading expositions that's going to be going on, where you can meet educators like Ace Enders. You can receive live education. You can ask photos. You can meet other traders, ask questions, rub elbows. It's really such a phenomenal experience. And for those of you that would like to show up to these events, I want you guys to go ahead and get your tickets right now, or feel free to get tickets for some of your loved ones or some family or friends. IM Rotterdam, we still have early bird pricing. This is going to be in March, so we do have a couple of dollars off, $70 to $100 off on some of these tickets. And then if you are in the States and you want to come to the IM Orlando, make sure you go ahead and get these tickets right away. The IM Orlando event only has a seating capacity of 2,000 people, and we are about halfway sold out of IM Orlando. So I have full confidence that by January, Orlando is going to already be sold out. So you want to make sure you go ahead and you get your ticket, so that way you can come be a part of our 3-day conference. Remember, for any of you guys that want to show up to these amazing events, simply come to imacademy.events. And by doing so, you guys will be able to come right here to this website where you can click Learn More or click Orlando. And then this will give you the option to go ahead and start registering for your tickets, as well as all the additional information that you need to be there at these events. They are such a life-changing experience. All right. Now, with that being said, guys, we're going to get ready to end our very first week of our 25 days of giving. We have successfully reached a few thousand people this week. So we want to thank all of the participants that are showing up day in and day out to the 25 days of giving, as we are successfully showcasing all of our academies, all of our strategies, all of our educators, and really just giving back to the community around the world for this holiday season. We hope you guys have been finding this as fun, as educational, and as informational as we all have, right? Continue to help us keep promoting. We want to wish you guys to have an amazing week. We will be back next week on 25 days of giving, next week on December 4th. And we're going to be starting off next week with a different variety of education. We will go back into MMX with Miss Millie Mills. We will be going into e-commerce, social media academy, travel, and then a little bit more into NFTs. So next week is going to be phenomenal. We look forward to you guys coming out next week. Make sure you guys are promoting the Zoom links. Make sure you guys are in the Telegram. Thank you guys so much for getting connected. Guys, have a phenomenal week, and we'll see you guys then.